Hey there, have you ever plugged your numbers into an online investment calculator, looked at that perfect, smooth growth chart and thought, that just seems a little too good to be true? Well, if you have, you're in exactly the right place. Today, we're going to dive into a tool that gives you a much more realistic map for your financial future.
And this quote, it just nails it, doesn't it? This is the perfect frame for our entire conversation. When we're planning for our future, we get so caught up chasing a precise, comforting number. But what if a realistic range of possibilities, even if it's a bit messy, is actually way more valuable?
All right, so let's start by tackling the big myth, the one that so many of us have been sold on. You know the one, that beautiful, clean, upward sloping line that promises this simple, easy path to wealth?
Oh yeah, these things are everywhere. They're super motivating, they're easy to understand, and they make long-term investing look like a total sure thing. You pop in your numbers, assume a steady, say, 7% annual return, and you just watch your future fortune grow. But the real world is never, ever that simple.
So why is that smooth curve basically a lie? Well, it's because it ignores the one thing we know for sure about the market. It's anything but smooth. It's volatile, it's unpredictable, and you know what? It's kind of chaotic.
I mean, just look at the contrast on this slide. It's night and day, right? On the left, you've got this clean, predictable myth. One line, one outcome. And on the right, that's the messy reality. Returns that swing all over the place, gut-wrenching crashes, and a whole spectrum of possible futures. The real world doesn't move in averages, it moves in extremes.
And this just spells out everything that gets left out of that pretty picture. Volatility isn't just some background noise. It's the entire game. These simple calculators ignore huge crises. They ignore that returns can be negative one year and then massively positive the next. And, most importantly, they ignore us, the human investors who might just panic and sell at the absolute worst possible time. A plan that ignores all of that isn't really a plan. It's more like a prayer.
Okay, so if that simple map is wrong, how are we supposed to navigate? Well, let's talk about how we can build a way better, more realistic map for our financial journey. And we do that using something called a Monte Carlo simulation.
So instead of trying to predict one single future, a Monte Carlo simulation just embraces the randomness of it all. It runs thousands, sometimes tens of thousands of potential scenarios. Each one has different randomized market returns based on what's happened in the past. It's not about finding the answer. It's about exploring all the possible answers to see which ones are more likely to happen.
I absolutely love this analogy. Just imagine you're a hiker getting ready for a big trip. You wouldn't want a forecast that only shows you the best-case scenario, right? A perfect sunny day? No way! You'd want to see all the possibilities, the chance of rain, the risk of a thunderstorm, so you can pack the right gear. That is exactly what a Monte Carlo simulation does for your finances. It prepares you for the journey no matter what the weather turns out to be.
Okay, theory is great, but what does this actually look like in practice? Let's take a look at a real-world example of an investment plan and see the power of this approach in action.
All right, take a look at this. This is a simulation for someone investing €200 a month over 35 years. Just let your eyes scan it for a second. See how it's not one single smooth line? Instead, what you're seeing here is this fan of possibilities, a whole spectrum of potential financial futures, from the incredibly lucky to the really unfortunate.
Now, this can look a little overwhelming at first, like a bowl of spaghetti, but the magic is in understanding the probabilities. Instead of a single, misleading number, we get a realistic range. So let's zoom in and make sense of 3 of these different paths.
First up, let's look right down the middle. This is the median outcome, the 50th percentile. That just means there's a 50% chance your final portfolio will be above this number and a 50% chance it'll be below. It's basically a coin flip. This is our most realistic central estimate, our roughly right starting point.
Now let's look at the optimistic side. This is the 90th percentile. In simple terms, it means that in only 1 out of 10 simulations did the outcome turn out this good or even better. It's possible, for sure, but it's an outlier. It's like having perfect weather for your entire 35-year hike. You hope for it, but you don't bet your life on it.
And now for the reality check. This is the 10th percentile. This means that in 1 out of every 10 simulations, the final value was this low, or even lower. This is the scenario where you hit a bunch of unexpected storms on your journey. It's not as reassuring to look at, but it is absolutely essential to prepare for.
So here's the crucial point. By investing those €200 a month, you have about a 1 in 10 shot of becoming a multimillionaire, a 1 in 10 shot of ending up with less than 400 grand, and a 50-50 chance of landing somewhere around 850K. Now you have a realistic spectrum, not just a single fragile prediction.
So what does this all mean for you as an investor? Well, it means shifting your entire mindset away from trying to predict the future and toward preparing for a whole range of futures.
Let's just boil it all down. First, that smooth investment curve you see online, it's pure fantasy. The real world is full of volatility that makes single predictions totally useless. Second, Monte Carlo embraces that reality, running thousands of scenarios to give you a realistic range of what could happen. And that brings us to the most important point. This method is way less reassuring, but it is infinitely more useful for actually making smart decisions.
Ultimately, this is the big idea. You've got to stop asking, what will my portfolio be worth, and start asking, what is the range of values my portfolio could have, and is my plan strong enough to handle both the best case and the worst case scenarios? Preparation, not prediction. That's the key to long-term success.
And that brings us to the final, most important question. This isn't about being scared of the downside or just banking on the upside. It's about seeing the entire map, all the possible paths your journey could take, and then asking yourself, am I truly prepared for what's ahead?